Welcome to the Property Corner with myself, Rowan Alexander. Welcome back to the First Time Buyers series. In this episode, we'll be chatting about the importance of using a mortgage originator. Mortgage originators, what do they do? Who pays for them? Are there any costs involved? And what is their role in the process? These are things that I get asked very often. A mortgage originator is a consultant that works on your behalf and communicates your bond application to the banks in a manner in which they understand. Now that's probably the crux of what you need to know. Banks have multiple matrices of how they look at things like income. Whether you're self-employed, whether you earn a salary, commission, bonuses, work overtime, you're getting rental income from properties. All of these things are looked at differently, and every bank has a different criteria and a different scorecard. So it's important that you make use of a mortgage originator because they can actually match your profile with the correct bank criteria. And they'll be able to advise you as to which bank will be the best suited for your needs. That's one of the elements that a mortgage originator, or one of the important things that a mortgage originator does. There's this perception that if I apply for a mortgage bond directly with my own bank, I stand the best chance of getting a bond. That's not the case. I myself have just recently been through a bond application for a property that I've purchased, and after a 12-year standing relationship with the bank and having had all my properties funded with them, I ended up going with the alternative bank on the latest property. And that was simply because my criteria and their score sheet, which they're using now, was a better match, and I could get a better deal on better terms with an alternative bank. So don't be fooled into thinking that dealing with your own bank is going to get you the best deal. A mortgage originator will go through that process of looking at your profile, identifying your source of income, and interpret that and communicate that in a way in which the banks will look at it favorably. In terms of their credit score and their requirements for finance application. What the mortgage originator can also do is apply to multiple banks and come back with multiple offers. This puts you in a position to consider all the offers from the various banks and ensure that you get the best deal for yourself. Mortgage originators are paid by the bank. It's a standard practice in industry that they will be paid by the bank. It's a value-added service offered by the financiers. There will be no cost to yourself. You also don't have to wait up until a point where you actually apply for a home loan to speak to a mortgage originator. Speak to them early in the process. They'll be able to give you advice as to how to best structure and prepare yourself for the bond application. Thinking back to the very first time I bought an investment property, I actually asked the mortgage originator to look at my credit score. And the particular bank in question at the time had an internal credit score, and my credit score with them was sort of average. I didn't understand it because I was earning good income and I was working diligently with my money. But there were certain things that I was doing while using my account, which the bank didn't like. At that point in time, I was saving in my primary account. I didn't have a credit card. There were a number of things which, after consulting with the mortgage originator and my banker, we could actually sit around the table and say, hey, Rowan, you need to get a credit card, even if you don't want one. But the bank is looking for payments which you don't control in the form of debit orders. So I actually activated a credit card, albeit for no money, but just to have that minimum installment going off my account. And I created a separate savings account where I would save my money not in my primary account. And within 3 months, my income had actually reduced. My commission earnings had reduced. But in the eyes of the bank, I was in a better position. And I could go from qualifying for an 80% bond right up to a 100% bond. Now, through that consultation process with the mortgage originator, I was able to make adjustments to the way in which I was dealing with my money before I actually applied for a bond. And when I applied for the bond, I ended up getting a 100% bond. Again, if you're looking to become a property owner, you don't want to find that out at the final hour. You don't want to apply for a bond once you've set your heart on a property, then only to find out that because of the way that you are doing things, or the way in which the bank views your income, could have been changed. We often see this with self-employed individuals. Self-employed individuals, often paying themselves a minimum salary out of their businesses, sort of just to get by, and retaining money within the business. And in some instances, the banks don't like that. They're going to require you to pay yourself a larger salary to ensure that you, as the individual who's applying for the mortgage bond, can actually afford to repay it, even if you are a sole proprietor. So these are things which the mortgage originator can give you advice on up front, early in the process, and you can make amendments in preparation. What are mortgage originators going to need from you in order to do that pre-qualification, to see how much you qualify for and provide that advice? They're going to need some form of proof of income. If you're working on a salary, you're working on commission, those would typically be in the form of a payslip. But any other income which you earn, whether it be interest, income from investments, whether you're getting maintenance from a previous partner, any other form of income, investments that you've made, all of that income will contribute towards your gross income, which will be taken into account when applying for a bond. But you'll need to prove them. So things like rental income will be proven through a signed lease agreement and bank statements confirming that you're actually receiving rent. Pay slips, we've chatted about. So agreements in terms of maintenance payments. These are things which will serve as proof of income. Second to that, we'll be looking for the bank statements which confirm that those incomes have actually come in, and also IDs to ensure we're dealing with a correct person, that we are scoring the correct profile, and also things which are legislative in nature. So proof of address. I think whether you've applied for a cell phone contract or purchased anything on credit or even cash before, you would have found that you've had some form of thicker documentation. The Financial Intelligence Center Act requires us to identify the person with who we're dealing. So documentation like IDs, if you are a foreign national, we can use your passport, and then also that proof of address. Those things will serve as a body of evidence for you, the applicant, and are important to provide to that mortgage originator so that they can do an accurate pre-approval. The exact same documentation will be used when you actually get to the point of applying for a mortgage bond. So you won't have to do that twice. If the mortgage originator who you use to do your pre-qualification ends up doing your bond application, they will have that documentation already. A month may have passed and you might need to submit your latest payslip and your latest bank statement, but you will only go through that process once of having to explain your position to them, and they can do that pre-qualification for you up front. This allows you to walk around with confidence and know exactly how much you can purchase for. Countless times I've come across people who say to me, Rowan, we've done a quick online sort of calculation and we qualify for 3 million rand. I had someone just the other day, and he walked in, he wanted to purchase a property, had done an online calculation and believed that he qualified for 3 million rand. The mortgage originator who I use sat down, had a look at his income, and because a lot of his income was in the form of commission and rental income, the banks only took 50% of that into account. So rental income, commission, these are things which the banks view differently. And in actual fact, he only qualified for 1.2 million rand. Rather than 3 million rand. Now, that's a big difference between what you believed you could qualify for and what you actually qualify for. So why things like that happen is, I'll use myself as a commission earner as an example. One bank will take a 6-month average, they'll drop the lowest value and they'll drop the highest value, and they'll take the 4 months remaining and they'll take an average of those 4 months, and that they will deem as your income. Another bank will say they look at 6 months, but they only take 50% of your commission into account. So a different bank will take 80%. And the same that applies to other sources of income. If it's not a salary, if it's things like rental income, these things are very often factored too. And that would just be an element that contributes to the amount for which you qualify. But the nature of that, your age, these things can all have a role in how long you qualify for, the duration, the term of the loan. You could potentially qualify for up to 30 years, but certain circumstances would mean that you now only qualify for 10 years or 15 or 20 years maximum loan term. These things can all be determined up front. That gives you the knowledge and the confidence to go out and shop with the correct budget in mind.